Well, thank you. It's a pleasure to be here. Thank you for inviting me. Can everybody hear me? Just type in number one if you can hear me so we can just get started, make sure everybody's good to go. Thank you. I know that some of you listening right now known about me for a number of years, and there's many of you probably listening right now who never heard of me before. But before we jump in, again, I want to say good morning or good afternoon to you. Let me ask you a question. If your spouse or family member asked you to go to the local grocery store, like your 7-Eleven, and pick up some milk and bread, without a doubt, you probably know exactly how to get there. Think about it. Am I right? So your wife says, hey, need some milk and bread. Without a doubt, you know probably one block down, take a left, 3 blocks over, take another right, or take another left, and then you're there. One of the major problems for many traders is not having the well-defined exit targets before entering the market. Traders typically focus on so much attention on trying to find good trade entries that they really don't know where to go to once they get in. And in my span of being a trader for nearly 20 years, if you don't know where you're going, likelihood is you're going to get there. But is that place where you get to where you really want to be at? Now, what we just heard from our previous speaker, I'm going to share a little bit more information about what John was talking about earlier. He showed some patterns. So what I'm going to do today is I'm going to go over 5 techniques of how to find high probable trade targets. Now, I've been in a trade room for over 8 years now, since 2008, and I've showed thousands of traders how to trade the market, but more importantly, it's where do you go once you get in? We spend so much time trying to figure out where to get in at that we lose focus, and some of our trade management is dependent on where we're likely to go. If you don't know where it's going to go, most likely you're going to be like some other traders I'm going to talk about here in a moment. So these 5 techniques I'm going to show you can work in the stock market, can work in the futures market, commodities. I primarily focus on the Forex. So whether you're a scalper, an intraday trader, like an active trader like myself, a swing trader, which I used to do, or you're a position trader. And I'm going to show you some of this information from a position trading standpoint as well as from a scalper standpoint. Okay? So I'm going to cover all the bases of any type of market you're trading and the style that you're trading at to identify clearly high probable trade targets. So I'm going to suggest to you grab a pen and paper because I'm going to give you one today that's my favorite. Just for showing up today, you're going to get my favorite trade target, no questions asked. You don't have to send anything into me or nothing. It's my gift to you. So grab a pen and paper and be ready for that. Everybody good? Give me a number 2 if everybody's good to go. Now I take it if they lose sound, I guess they log back in. I think that's correct. So let's get started. As a licensed broker under the National Futures Association, it's important for me to make sure that you're fully aware of the disclaimers in trading stocks, options, Forex, futures, and so forth. And there's no representation being made that any software or trading will guarantee profits or not result in losses from trading. Also, I'm going to share with you some testimonials. I'm required by law to mention that testimonials shown in the presentation are received via email submission. Their individual experiences reflecting the views of those clients who have used our products and their services, and they're not representative of all clients who use our products or services, and we make no admissions of such. So each testimonial is representative of the views of the individual submitting the testimonial and not representative of all clients. All right, with the housekeeping out of the way, let's get started. A little bit about who I am, because you may be asking yourself, why should I listen to this guy? Fair enough. For those of you who don't know who I am, I was a private trader back in the late 80s, and then I was one of the first online traders with a company called D.O.T.S. If you remember way back to 1990, they were one of the first online trading firms. Maybe some of y'all traded through them. But I've been trading Forex, the foreign currency market, since 2002. As I said, I'm a licensed broker. I'm a National Futures Association member and a commodity trading advisor. I've been interviewed by CNBC, Reuters, CNN, the Wall Street Journal, and others as an authority in the Forex market. And I've trained tens of thousands how to trade Forex. Now, if you want to learn a little bit more, regardless if you're trading Forex, futures, stocks, I'm going to make a suggestion to jot down that web link right there, because I've got over 250 free videos on all sorts of topics about trading the market. Okay? Now, let's go over the main reason why I'm sharing with you today some of this information. It's where to exit with the greatest amount of probability. Now, just like John spoke about in the previous, in his webinar, the previous webinar that John gave, he was talking about where potentially we can go, and he was using a technique that's known as a measured move. I'm going to share a little bit more about that today. But the key is can you define clearly the highest degree of probability where the market's going to go? And I'm not kidding when I say grab a pen and paper, because you don't want to miss about anything about this. Now, for me, I look at history and go back in time, but I trade from the hard right edge. That's the key. Everything I'm going to share with you today is trading from that hard right edge. Do you understand what I mean? Does someone not understand what I mean when I say the hard right edge? Let me give it to you this way. Can you drive your automobile looking in the rearview mirror? No, you can't. You can drive looking forward, reflecting back, maybe look in the rearview mirror, but if you can't constantly look in the rearview mirror, well, looking at chart history, you're just simply looking in a rearview mirror. But what you see in a rearview mirror, as far as what the charts are showing you, can give you some clues as to what you can see coming forward. Okay? Now, and so what I'm doing in my trading room is I'm showing folks from the hard right edge techniques to use. So let's get started. With high probable trade targets. Now, just FYI, I've trained lots of folks across the globe. Here's Gene. I just talked to Gene, as a matter of fact, yesterday. He said before using high probability targets, I would only try for 20 or 30 pips. Now, for those of y'all who are familiar with the Forex market, that's what I'm talking about here. For those of you not familiar with Forex, a pip would be like a point, or your smallest minimal point as you trade. As soon as there was a pullback, I quickly exit my trade for fear of losing what I made. Whoa, whoa, whoa. Let me get started here. For whatever reason, my slides aren't moving forward. There we go. There's the disclaimer. There's the testimonial disclaimer. This is my resume. Sorry about that, folks. My slides weren't moving. And there's the link I was talking about right there. Okay. Now, and the question was, where do we exit with the greatest amount of probability? So we're going to talk about high probable trade targets. First off, I want to talk about some of the folks that I've worked with. Before using high probability trade targets, I would only try for 20 to 30 pips. As soon as there was pullback, I'd quickly exit my trade for fear of losing what I'd made. Now, reason why I'm sharing these testimonials with you is because I talk with a lot of traders who don't know where the market could potentially go hereafter. So after I share with Gene some of the things I want to share with you today, as a matter of fact, he uses my favorite trade target. His comment was, after using high probability targets, my trading has totally changed. I have a clear target that gets hit nearly 90% of the time. Now, if you're listening to me right now and you would like to know most likely a high probability target that gets hit 90% of the time, stick around. Here in the next few minutes, you're going to get it as my gift to you. Tammy writes, before high probability targets, I would trade for only 5 or 10 pips. If price kept moving, I'd hope to exit for 20 pips. At 20 pips, I felt like I hit the jackpot. But if price hesitated, I was out of the trade. I didn't know where the market might go, and the not knowing created anxiety and fear in my trading. How many of you are trading right now with the not know? So you got a little anxiety, you got a little fear, trying to conquer that fear. What I found in my years of trading is logic defeats doubt. Logic defeats the emotions. We're emotional creatures. We're not going to get away from our emotions. As a matter of fact, the better you know yourself and your emotions, the better the trader you will be. But if you can have a logical reason and a logical understanding of where the market could potentially go to as you're trading, you're going to find yourself in a much better position. As a matter of fact, Tammy wrote back and said, now it's like night and day. It's amazing to know what the market will most likely do and then watch it do it. I know how to look for price projections, pullbacks, and even know where I'm going to add to my position for even more pips. How would you like to know where to add? Some information I'm going to share with you. And then Janet writes, and Janet's great. She's a sweetheart. Before using high probability targets, it was like flipping a coin to see where the market will go. I was relying on others to forecast or suggest where it might go. I tried all sorts of indicators, followed advice of pros, but nothing worked consistently. I was stressed out. How many of you have been going from guru to guru to guru? And I don't consider myself a guru. I'm just a trader. Never worked a day of my life on Wall Street. Got a lot of buddies who've worked Wall Street, but I took a hobby and turned it into a profession. I love this. I'm passionate about it. But there's things you can see if you know what to look for. They've been on the charts all this time. And one of the things I'm going to share with you today, one of your homework assignments is to go look at the charts and find out if the charts tell you exactly this one particular technique over and over again. Janet writes now, trading with a high probability targets is like having a GPS on your chart. I already know where I'm going to exit and why the market's doing what it's doing. My trading results are better and my trading is more relaxed. And isn't that what you really want? Ask yourself, would you like to be more relaxed in your trading and have the better results? That's a rhetorical question. We'd all want that. More confidence, better ease at trading, and then hitting our results. And then, basically hitting our results more times than not is going to give us that greater amount of confidence. So with no further ado, what I want to do is share with you that at the end of the presentation, I'm going to give you a special link where you can get my complete trade target report, video trainings, indicators, and more. Okay? So some of these trade targets you're going to be familiar with. This one, for instance, I think everyone should be familiar with. Some of you may be using pivot levels. Now, the pivot level that I use is what's known as a floor pivot. There's floor daily pivots, floor weekly pivots, and floor monthly pivots. But what I want to address to you is this. If you were trading, and right over here, can everybody see my chart? And type a 1 if everybody can see my presentation. I just want to make sure everybody's with me right now. Okay? And I'll take some questions along the way, but there's a lot of information I want to share with you. Now, I already see some questions coming across, so bear with me. I'll have some time set aside to answer some questions as we go along. So here's the start of the day. This area right here shows the start of the day. What you see over here is the daily pivot, the daily R1, the weekly pivot, and the weekly R1. Now, if you know where these pivot levels are, and pivots have been around for years, they're used by algorithms, trading systems, individual traders, institutional traders. Personally, I'm not the biggest fan of pivots because the market has a tendency to fade the pivot. It has a tendency to work its way towards the pivot and then fade it. Sometimes it'll hit it, sometimes it won't. And there's some things to look for. As you're going to learn today, many of these speakers are going to share with you that like John mentioned, smart money. Smart money, the guys who make the markets, the big boys who make the markets, okay, referred to as market makers, they got us just thinking this is the right time. They got us chasing after the market where they know where they're going to get. So as you're chasing, trying to get on or trying to get in, they're fading. They're coming out. They're collecting that momentum grab, and they're already at a high probable target. Now, one of these here, as you can see, the market came down, tested the daily pivot, faded it, didn't actually hit it, faded it, came back up, and then the market progressed, shot right through it as if it wasn't even there, and then progressed on down to the weekly pivot, turned, and made its move back to the upside, to the daily R1. Now, I know many of you have seen this type of action before, okay, if you've been familiar in trading. Anybody here traded? Type in number 3 if you trade with pivots. If you trade with pivots, you know what I'm talking about. Seeing some 3s coming across. Good. Now, if you notice how the market came back down and sat here for a little bit, tested in this area, because what the market's doing here is that this area that was offers, the market was offered back here, okay, or resistance is what many of us refer to, but these are institutional offers sitting here, no sell limits. This resistance level now becomes a support level, where now the offers that were rinsed out, market absorbed, buy limits come in, the market moves above, new buy limits known as bids are coming in, and the market gets bidded up, and where does the market go to? That's just one example, okay? Now, look for, what I'm going to recommend for you to do when you're using pivots is to look for confluence. Look for confluence between the daily and weekly pivots, or the daily, weekly, and monthly pivots, okay? But you use that confluence area as a target level. You can see how the market moved right down to the DS1, bounced back up, tested this, and this gives me a lower high, and continuation of lower highs, you're into a downtrend. Notice how the market went all the way down, and it even just kind of shot right through the DS1 after fading it. Remember I said how the market might fade before it actually hits, okay? But the market does come down, but look what it does. It comes into an area to where we have our DS3 level, our weekly S1 level, and we have the monthly pivot. I don't know if you can see or not, but this is my weekly pivot line coming across, and this is my pivot line for the monthly pivot line right there. And these are tools that are developed for the MetaTrader 4 platform. Okay, consider exiting ahead of a pivot level unless the fundamentals are in the direction of the trend. Now, you're going to hear different opinions about fundamentals and technicals. I like to use the word techno-fundamentalist because I'm using technical charts to determine where the market's going to go, but I've got to understand that there's some reasoning behind the market, and sometimes the fundamentals, these economic releases that come out, or the other information you pull from the market, is an instigator. It simply instigates or causes the market to react or respond based upon that economic release. If that economic release is favorable, you're going to probably have positive sentiment, positive intent in the market moving in that favorable direction. If that economic release comes out with a negative sentiment, most likely you'll have the opposite, more of a negative reaction in the market. Okay? But please understand, when that economic release comes out there, more times than not, the big boys, the institutions, the trading algorithms that are run by hundreds of large institutions, okay, they're already probably in positions or staged into positions. You and I at the retail level are often running at the coattails of what the institutions are already doing. So what I'm going to share with you are some techniques to trade along with them and understand most likely where these algorithms are going to go. Now, as John alluded to previously in his webinar, that these algorithms that are run in the marketplace are a set of rules based on a set of calculations. When you take these calculations and you know the rules and you combine it together, you yourself, in effect, are a real live algorithm. Understanding what these algorithms are shooting for, more times than not, if you know what the rules are, you can play by those rules. And I've been studying the algorithmic world now for nearly 10 years, just trying to understand bit by bit what the algorithmic world does. Now let's talk about, that's pivots, and at the end of this presentation there'll be a link that you can go to if you'd like to get the pivots levels indicators that I use. The next one, some of you might know about, some of you may not know about. This is called the average daily and weekly ranges. Now, years ago, there was a friend of mine, Kim, who had mentioned to me, you need to be watching the average daily ranges. And I was like, okay, sure. But the more I studied and studied, I found that the average daily range, the average weekly ranges, the market plays to those consistently. Price has a tendency historically to work range levels. They'll oscillate up and down within ranges. These ranges can be small, these ranges can be large. Why in the world does the market go back to, quote unquote, a resistance level or, quote unquote, a support level? That's where the market's been before. Price has a tendency to go back to where it's been before. So we're going to look for a range, the average daily and weekly ranges. Now, I'm not talking about an average true range. What I'm simply talking about is the daily high minus the daily low over a period of days that's averaged down. So let me give you an example of what I'm talking about. The average daily range is a gauge of maximum amount of movement within the day. We can use the average daily range to identify targets based solely on historical price activity. And that's what I like about using the average daily range, from the standpoint that there are no indicators. All indicators can be lagging to some degree. There's probably neural network indicators that are leading, trying to determine potentially where the market's going to go, but there could be some fundamental release that causes that to be totally incorrect. What I'm looking at here is I'm looking at just price. And what you see on this is a tool that I've developed called the Average Daily Range Pro Calculator, and it lays out weekly levels from Sunday evening through Friday afternoon. These levels do not change. Now there are daily levels, daily average daily range levels that change day to day to day. But as you can see from the start of the week, somewhere back before, the market came down. Oh, here we go. I'm sorry, here it is. The weekly open is right there. And at the start of the week, we moved down to a level, hang out around that level, and then look what the market does. It pins down to the weekly low level, retraces up to the weekly open, hangs out in this area, probably hitting into some offers in the marketplace. Those offers are absorbed, the market works up and hits the weekly mid-high, and we bounce back and forth. You can see it right there. These levels, for those of you who trade the Forex, are phenomenal levels from the standpoint that you can trade hourly, 4-hour, or closer in intraday charts like a 30-minute, 15-minute, so forth. But these levels, I've got traders who use these levels in the market. It's just kind of magical how these move to how the market will move to these levels. Also, what we're wanting to do is when, like I said, the average daily range is the difference of the daily high and daily low averaged over a period of days. Now, the weekly ranges are set related to the average of the weekly highs and lows. So these levels here are based on an average of weekly highs and lows. Now, you can do this on your own. You don't need a tool. I just like to have a tool that goes and places on the chart those levels that I can see instantaneously every day. Now, there in the tool I've developed where we know the average daily range high target and the daily range low target based upon the number of days of trading. Let me make a suggestion to some of you who may be using average daily range and you're looking at a monthly average daily range. Do yourself a favor. If you're using 30 days, you're putting in 30 to deter 30 days and trying to use that as your average daily or the average monthly range over 30 days, stop doing that. Just stop doing that. Use 22 days. Why? 22 trading days on average a month. Okay? I've worked with a number of traders, some who use the average daily range, not my particular tool, but they do their own calculations using an Excel spreadsheet, and they type in 30, and that's completely off. Only look at 22 days because that is the true trading days of a month. Okay? Now let me give you an example of what I was talking about of using these weekly levels. You can see how the week starts out. This is the Aussie dollar on a 1-hour chart, and you can see that the market's range bound. And you can see how the market had moved down to a level, couldn't break below it, bounced off, and went to a level. Stayed at this level, couldn't press any further, and there's an economic release right there. Some economic release was right there. And what was happening, as what was alluded to in the previous speaker's presentation, was the market was in wait right there. And then we had the instigating fundamental report, and it caused the market to drop. Notice how the market fades the level, comes back up, and then hits it. Now what you're looking at here are what I created called average price bars. They're like Fibonacci bars, but they're developed specifically for the Forex market. The market actually then moves back towards center near the open of the week, and you can see the rest of it. But we use average daily range levels or for the day and for the week to identify and trade a range-bound market, which many of us have seen, especially for those of us trading the Forex. We've seen how tight the ranges have been as of late. Then we have a follow-through. So you can see how the market comes down here, and then we get this follow-through. Well, actually, this is a different chart. This is the pound dollar. But imagine, if you will, the same scenario. Market comes down, and it drops from level to level. And I have these type of charts that occur over and over and over again. This is not anything special designed indicator. It's just very synonymous with what Wall Street and the major money centers around the world use. they use the average daily range. Now, for those of you who may be using average true range, okay, you've bought into the Kool-Aid they're serving, unless you have an average true range strategy. But an average true range is based on 3 different scenarios, and I don't have time to go into each of those. But I've found using this tool since about 2005, 11 years of using this type of average daily range, average weekly range. It's been amazing to watch with no indicators, just price alone, to watch it statistically go to levels over and over and over again. Everybody with me? Type in number 1 if everybody's with me. Market open. Now here, based on someone asked me about the market open. When I talk about market open, I'm speaking of, in the Forex, it's based on the international date line. Crossing over the international date line, Wellington, New Zealand gets started, and that's more or less the start of a new Forex day. Okay. Now, can you use these levels based on the London session? If you're trading the London Open, I do have another tool for that. Okay, but you can use these same tools. So as you can see, this is based on the open of a day, and trading the Forex market. The open of the day used by many professionals around the globe, even though retail brokers have a tendency to change them, but from a professional standpoint, institutional standpoint, the start of a brand new day in the Forex is going across that international date line. Now, let me talk about target number 3. And target number 3 is what's known as a measured move. This is what John, our previous speaker, was alluding to. A measured move, without necessarily calling it a measured move. But a measured move is the secret of chart patterns. Now, a few years ago, I did a video series, a 6-part video series that today you can have access to if you'd like. But I did this video series, FX Street, for those of you familiar with the website fxstreet.com. They nominated this video series as one of the best training series on chart patterns for that particular year. And it all boils down to understanding the secret of a chart pattern. And as our previous speaker alluded to, and I totally 100% agree with, that if you can identify a chart pattern as you trade and see what that chart pattern is setting up to do, if you use measured moves, well, let me put it this way. From all the studies I've done and looked at different folks like John Murphy and what he's written, Thomas Bukowski in his book Encyclopedia of Chart Patterns and his website, and various other studies that I've done over the last 20 years, chart patterns complete themselves 65 to 85% of the time. Now hear that. Did you just hear that? 65 to 85% of the time chart patterns complete themselves. So if you can see a chart pattern developing and you have proper money management, you're already ahead of the curve. Do you get what I'm saying? When they talk about how 90% of the traders out there lose, and trading as a whole is more often a losing proposition than a winning proposition, but if you've studied chart patterns and you become a student of them and you see the setup and you see what makes them work out and what makes them not work out, you're going to be ahead of the game if you can control the trade management portion of it. Control yourself, the emotions, and so forth. So let me talk a little bit more about what a measured move is. A measured move is a calculated distance in a chart pattern. And let me say this again, every chart pattern has a measured move. Why do we do chart patterns? Because chart patterns have a destination. That destination, a target, is highly probable target. So we apply this again as a logical profit target. So if as you're trading, you have to understand that to control your emotions as a trader, exchange those emotions for logic. See, I found in my years of teaching traders, and I've trained tens of thousands of traders, is that when someone says, I don't know, it's because they don't know enough. If you knew enough, honestly, ask yourself, if you knew enough about trading right now, would you be on this webinar? Would you be listening to me? Or would you know exactly every single time what I'm going to do? I've got it down pat. I figured it out. See, I've got traders who've actually written me and said, Dean, I'm not going to be part of your training room anymore because I've figured it out. I got it down. I know now what I'm looking for. Thank you so much. I'm on my way. Those are some of the best emails I've ever received. Now, with that in mind, let's talk about the measured move. Let's just look at the double top pattern, also referred to as the M pattern. Is everybody familiar with an M pattern? We have two highs. Market comes up, comes back down, comes back up, and then forms an M. Very simple. So if I were to draw an M here, everybody would understand that if I took, let's say, a pen here, and I were to draw, for instance, like this, if I were to draw that and stop right there, and I told everybody in the room, I asked everybody in the room, complete the letter M. Without a doubt, anybody who understands the alphabet, okay, would then just start going, yeah, it goes down. And where's it go to? Does it go way down here? No, it goes back down. Excuse me, I can't draw here too well, but it goes to the floor. Everybody knows this right here. Even the algorithms know that, okay? So with that in mind, let me see, what we're going to look for, and this is how we're going to do it. You're going to take the average highs up here. Let me bring this down. So we have resistance, the average high, A and C, and then we have our support level, okay? And then our entry is going to be the break below that midpoint. Now that's what retail market is looking to trade at. As a matter of fact, in my training room, I teach folks about the institutional entry. There's an institutional entry on a double top pattern, and it's not what you're being taught to look for on the break of the midpoint. But break of the midpoint, most everybody looks for, okay? And then what we do is we take that measurement from the average high to the midpoint. The black arrow represents that measured move, and we simply stack it. And that's our target. That's what we look for, okay? Everybody got this? Is this new? Type in number 2 if this is kind of new to you. And if measured moves something new to you, you've not heard of before, type in number 2. Some of you are typing number 2s. I'm telling you what, guys, get measured moves down. These are high probable targets. They work in every market that you can trade. In my opinion, you know, I don't trade bonds, so I don't know if they work in the bond market because I don't trade bond market. But I've seen over and over and over again how the market moves to measured moves. Let me give you another example. Or here's an example here of a chart here. We have a move up. We have a tweezer top. You don't need to know that. It's not a big deal. Okay. We have a pin high. The market putting in a lower high, trying to hammer out top of the market. For those of you who use Japanese candlesticks, I take that average high. I measure the distance to that average low point. Now, some of you might say, but Dean, I've learned that measured moves are from or the measurement you take is from the highest high to the lowest low point. That should be your measured move, not the average. Let me tell you something. If you're adamant that's got to go from the highest high to the lowest low in this example, you're missing out on the big picture. Majority of algorithms out there that are being used, the calculations are averaged. Why? Because an average level is hit more often than the extreme high or extreme low. Make note of that. You'll see it over and over again. My recommendation to all the traders I've worked with is take your average high, take your average low, take that measured move, stack it down, look where the market goes to before it bounces back up. Okay, that's just one example. You can do a fib move too. Yes, we're going to get into that in just a moment. Absolutely. Okay, now, I'm just simply saying there's no tools here, guys. I'm not using fibs. But someone just wrote in, well, could you do an actual fib move? Yes, you could, and I'm going to show that in a moment. But what I want to share with you, of the tens of thousands of traders I've worked with, there's a lot of folks out there who just can't wrap their mind around a fib and how to use Fibonacci extensions or Fibonacci retracements. This is a way you're simply using price action, chart patterns to determine a potential high probable target. Let me give you another example. The previous speaker alluded to a bullish flag. Well, there's a bullish flag right there. We have the flagpole coming up right there, and then a flag. Now, what does a flag represent? A flag represents some profit taking, some consolidation, whatever you want to call it, a correction before continuation. And with this big move up, this nice trend to the upside, this consolidation pattern that we're getting right now, recommends or suggests a move up. Now, I want to share something with you, because you may be looking at this saying, well, I can see the measure move, because the measure move, I go from the high of the flag to the low of the flag. And then we look for the break of the flag, and we take that measurement and we move it to the upside. That's the distance. Now, I know some of you might be saying, but hold on a sec, Dean. What about all of this up here? I just missed out. Let me share something with you that when I was told this by a buddy of mine on Wall Street, it changed me as a trader. It changed the way I look at how the market gets traded. Okay, and it really opened my eyes to what was going on to some degree. And this is it. Wall Street is not about making the biggest gain for the day or the biggest move for the day. Wall Street is all about making the highest probable gain for the day. Because if they can get the highest probable gain, day after day after day, they can load up and go after that high probable target day after day after day. Does that make sense? See, you and I, as retail traders over the years, have been taught that, oh, we'll extend all the way to here, go all the way for that. How many of you been using some targets out there in the market? Just, I went to this seminar, I was taught how to go for this target, but then it doesn't seem to want to get there most of the time. I'm going to share with you something in just a moment. So I'm not so concerned about what the market continues to do, and I'm not suggesting don't stay in there. I'm saying that you could take the measured move, take a partial of your trade off if you'd like, or bring into it a trailing stop and trail it to that point, but just be aware a highest or a high probable target has been reached. Okay, here's an example. I cannot not show you what this means. Look what the market does. Whoops, excuse me. Look what the market does. It goes, we take a measure move, flag high, flag low, we stack it on the break. Look what the market does. The market goes up to a measured move, fades all the way back. Now what happens for most traders is they're looking at, well, this should be going higher. Okay, maybe they're looking at some other distance or some other target way up here. But it takes the measured move, fades back, you get stopped out. And how many of you have gotten stopped out almost to the point or to the pip and just see the market turn and go? So in this case, you could literally take some off right here, place a stop loss, a trailing stop loss you might have, or a stop loss underneath this last swing low, market doesn't hit it, or gives you another opportunity to step in. Anyway, this is about measured moves. So I found in my years of trading, these are the top 10 chart patterns that are repeatedly traded. Algorithms trade these quite often. A range breakout, head and shoulders, inverted head and shoulders, a double top like the M pattern, double bottom, a W pattern, triple top, triple bottom, bullish flag, or a pennant. Now a flag looks like this. A pennant is going to be more of a triangular flag. You got lower highs and higher lows. So you have a bullish flag, bearish flag. You have triangles, wedges. There's all types, different types of wedges, symmetrical wedges, rising, falling wedges. And then you have what I call the 1, 2, 3 up and down, which is one of the strategies that I've used over the years. But I see this, it's a retracement type pattern. So my question to you is, do you know the measured move of each one of these patterns? These are the top 10 traded patterns. And I've seen it in the stocks. I've traded stocks, I've traded options, I've traded commodities and futures, and I've traded Forex. And my favorite at this point is Forex. I enjoy trading Forex. Okay, but I see these regardless of the market. So my question to you is, do you know these? Do you know the measured move of each of these patterns? If you don't and you want to know, stick around. I'll share with you a link in a moment. Okay, last but not, well, number 4, we got 2 more to go here. The special Fibonacci extension. Now, this is where you really want to grab your pen and paper, and I'm very serious about this because I'm going to give to you my favorite trade target. In my opinion, it is the best kept secret on Wall Street, and I'm going to prove it to you. I'm going to give you some charts. I'm going to show it to you, and your homework assignment is going to go out there and do it on your charts. I don't care what you're trading. Go out on your charts over the weekend and test this. And your eyes are going to open up and you're going to go, oh my goodness. Okay? Or at least the traders I've shared this with. Now remember I talked about Gene said earlier that one of the high probability targets that he uses gets hit nearly 90% of the time. This is it. Okay? Now, so here we go. My favorite trade target is a 127.2 and a 141.4 fib extension, especially the 127.2. Okay, and this is a trade secret here, guys. And algorithms are built to look for this. Where do you measure your fib? You measure it from the last swing high and the last swing low. Last swing high, last swing low. Craig, you were talking about in that flagpole. You can, but that you take the measurement of the flag. If the market continues going higher than the flag, then take the measurement of the flagpole. You're right about that. But the flag is the highest probable target. All right, so let's back to this. So the measure from the last swing high to the last swing low. So let me share with you, where do I come up with these numbers? Well, this is a harmonic number, but some folks have never heard of this number. Okay. When I was a retail trader, earlier in my earlier days, I'd, like many of us, gone to different webinars, seminars, flying around the country, seeing these gurus. Well, one guru that I went to said you got to always look for the 1618, and you always got to look for the 200% extension. Okay? Anybody using the 1618 fib extension or the 200% fib extension? Anybody? Type in number 3. You'll see the chart here in a moment. Bear with me. I'm giving you plenty of examples. Bear with me here. So many of us are trained to look for these two. But built into algorithms, remember what I said? Retail has a tendency to chase momentum. Smart money already knows what they're going to do, and as that chasing momentum increases in the market, they're fading, fading, fading. Smart money is fading. As dumb money, you and I refer to as dumb money, and I kind of look at that and go, okay, hold on a sec. I'm the dumb money? Yeah, because the smart money are the market makers. They are smart because they know what they're doing. They know where they're going in. So I guess that makes them smart money. But let me give you some examples of this. So a 1618 is the 127.2 is the square root of 1618. The 141.4 is the square root of 2. This is an algorithmic equation that's used in a number of algorithms. Okay, guys? So let's take a look. All right, so this happens to be the Aussie yen. I'm going to give you all plenty of examples. We're even going to look at the stock market, oil market. We'll look at the gold. I got some examples for you. So I take from the swing high, and again, this is the last swing high, last swing low. The market presses up, fades a bit, but then pins right at the 141. Settles back to the 127. Okay. By the way, it closed and settled at the 127. Now, there's a level in between here that I teach folks in my training room what to also look for, because if you get an extension and the market starts to fade, there's certain things you need to be looking for. Let me give you another example. Here's the swing high, and here's the swing low. Okay. Les, I recommend you go out to Google, study a little bit more about Fibonacci's, okay, because 1.628 is not it. It's 1.618. You do have a 1.618, I think it's 5, but it's 1.618. It's referred to as the golden mean, or the 618 retracement level. Just do a little study on that. You'll see what I'm talking about. Okay, so here's a swing high. Now, don't take this one because that's just a reversal pin, bar, the 1 bar reversal, whatever you want to call it. There's a swing high, swing low, market comes up. Look what it does, the 127 and the 141. I can't tell you how many times as a private trader over the years, I was looking for the market, going to these gurus, and they were telling me, go for that 1618, go for that 1618. As the market was approaching the 1618, I was like, man, I was getting happy. I was already spending my money. The trade wasn't closed yet. And I would see time and time again the market fade, fade, fade. How many of you have seen, if you're using fib extensions, how many times have you seen the 1618 fib extension not get hit? The market fades it. Now, not to say it won't hit it, but again, I'm not talking about the highest, biggest move. I'm talking about the highest probable move. And if you can, like Gene, get your targets hit 90% of the time, as he quotes, I would much rather be doing that than hoping that the market's going to go to that highest extreme, where everybody and their dog knows 1.618 if they've been in the world of trading. Everybody knows about the 200% extension or the 1618 extension. Not a lot of folks know about these. These are built into algorithms. So let me give you some more examples here. Okay, so here's the bread exit. From swing high, swing low, it comes all the way down, and notice how the market hits the 141. It did go down to 1618. If you extend it now down from high to low, we go down to 127.2. All right, here's the Dow monthly chart. Swing high, swing low, the market comes up to 127.2, the 141.4. We are getting close to the 1618. We just haven't hit that yet, but you can see how often the market hits and holds that 127.2. Here's the S&P. From a swing low, swing high, it retraces back and then presses up and tags right at the 127.2 level. Here's the NASDAQ. Swing low, swing high, back and forth, about a 50% retrace, and then up to the 127.2 to 141.4 area. Here's the move from swing high, swing low, pulls back, drops again. This is oil, by the way. This is the oil market, comes down to 127.2, 141.4 before the pullback. Here's gold. Gold from the low to the high, swing high, pulls back, and then up to the 127.2. Tags it right within like a point or so of tagging the 127.2. So if you don't use the swing high, swing low, suggested to use the previous day's low, the previous day's high, and the market bounced a little bit back and then went right to the 127.2. Okay, so look for that in your charts. Here's another example. Here's a swing high, swing low, market works to the 127.2, comes back, and then finally works its way up to the 1618. Okay, last but not least, another method I use is called the D.O.T.S method. D.O.T.S method was designed to give traders entries, targets, and stop losses as they trade. It's a one indicator that does on a buy side or the sell side of the market. You can trade it for various different sessions. Someone asked me about the London session. You can do the London session using this tool. Give you an example of this. This was August the 29th, just taking some snapshots. Here's what it looks like. It places levels on your chart from the open of a session. They're automatically drawn on the chart. This was one trade that went from the open, from a sell entry level down to a level for 21 pips. Down from the sell entry, this one actually progressed all the way down to the sell target number 2 level for 35 pips. This one went all the way down from the open of the day down to the sell target number 2 level, or actually it bounced back up to the sell entry, so only took that's a break even there after it breaks and goes down, 32 pips. Another one here going down to the sell target number 2 for 43 pips. These are pound yen. What I basically took on that day 4 pairs, euro dollar, pound kiwi, and pound yen, trading the European session for 131 pips, only trading either one long or one short position. So, and it comes with additional tools to help us filter better trades called the multiple moving averages. So all in all, I've shared with you today 5 different high probable trade target techniques. pivot levels, average daily weekly range, measured move, fib extensions, and special fib extensions, and the D.O.T.S method. If you want to get my complete report, go to www.CompassFX.com/TT for trade targets. I'll give you a blueprint. This is a complete report that I've written that you can use. You'll also get pivot indicators already designed for MetaTrader 4. There's an ADR, average daily range spreadsheet, that's already made for you. And there's video trainings. Remember we talked about the measure moves. There are, you'll get the complete 6 video series training on how to trade measure moves. And you'll go to www.CompassFX.com/TT. Now, for all of this, it's a small charge of $7 to get all this information. We've sold this package for much, much more, but for today, it's a $7. You get all of what I talked about here. Okay. Do I got another minute or two for any questions? Makes sense. Got caught in no man's land between 127.2 and 1618 so many times. Thank you. Would these numbers be the same? I'm actually using on fibs. I'm actually using a fib retracement tool. I just built the extensions onto the fib retracement tool, and I simply run from the swing high, one line from swing high to swing low. Okay. If there are more questions, you can send me an email to support@CompassFX.com. I want to thank the good folks at MTI for allowing me to give the presentation today. Y'all make it a good day. Get some good trades. Use some of these techniques I've shared with you. If you want to get my full report and get all the other tools that come along with it and the trainings, simply go to www.CompassFX.com/TT. Thank you so much. Have a good weekend. God bless.